All right, so as promised, we're gonna do a quick workshop, so I wanna go over the rest of the afternoon. We're gonna do a workshop right now where we're gonna cover, I'm gonna give you 4 tools to help you guys take your next steps, and then we're gonna build out your next steps. We're gonna do a hot seat, we're gonna do a workshop, we're gonna make sure everybody has what they need. And if it spills over in this evening to make sure you got it, we're gonna make it happen, okay? So these 4 tools though, again, I love ad-libbing and making sure we give you guys the best possible experience based on your feedback. After talking to the VIPs at lunch, what we decided was, why don't we go through these 4 tools, and instead of me going through them all and bullet points and more PowerPoints, we're gonna break down each one of them in your situation. So it's gonna be a little Q&A each one of these, and I want you guys to give me some hypotheticals, like, hey, how do I do that, right? And we'll go through each one of them like that, because I'm telling you, these tools, I want you to think about how you can implement them, right? And if we have to go for an hour going through all your guys' questions with them, let's do it. And then we'll get into your 90 days, okay? So 4 tools. All right, we're gonna talk about 4 ways to guys help you guys come up with the capital to do more deals. All right, number 1, HELOCs. All right, HELOCs. We're gonna talk all about HELOCs. Number 2 is gonna be another form of line of credit. It's gonna be your stocks or your portfolio or other assets that you can take line of credits on. Let's call it alternative line of credits, alternative LOCs. All right, number 3, Carolyn's favorite. What is it? Self-directed IRAs, yeah, or 401ks, right? Some self-directed stuff. And number 4, one of my favorites, 0% interest credit cards. All right, we're gonna break each one of those down, and I'm gonna let you guys ask specific questions on each one. You're gonna give you guys all you need with these 4, okay? Number 1, the HELOCs. So I wanna unlock something for you guys that will completely maybe flip your mind on using a HELOC. And I've presented on this before. Has anybody else ever listened to one of my YouTube videos or seen me on Problems to Profits talk about HELOCs? Anybody seen that video?
Yes.
Yes. So HELOCs, this is an incredible thing. I learned this at a mastermind, like one of the first ones ever, like 4 years ago. I was talking to Alan. Alan's the guy that helped teach me how to wholesale. And I'm talking with Alan, and we're talking about lines of credit. He goes, Casey, no one gets this. He goes, everyone wants to go out and get a term loan, what we call a term loan on your property. So what a term loan means is what probably all of you guys have on your house. Right now, it's a 30-year fixed, most likely, or maybe it's adjustable. But it is a fixed loan, and all the payments are fixed, or at least for 5 years, or potentially 30 years fixed, right? So you make that payment every month, and you're paying down your principal. But what if after 5 years, you pay that down, a good chunk? What if you want to go access the principal you've paid down? Because you guys all understand the difference between principal and interest, right? Every month, you're making a payment on principal and interest. But all that principal you pay off over 5 years, can you access that? Or how do you access that? Is it easy? Yeah, you got to refinance, right? Which now you're subject to more costs, potentially adjusting your interest rate, a bunch of paperwork, right? But you got to refinance is your only option, okay? Now let's flip the script on that. If you go out and buy a property with a line of credit, it's completely different. So now, when you pay down your principal, can you go access that? Can you go back, if you paid down, you had a $400,000 loan, let's make it a little bit more approachable, a deal you guys could think about. So let's say that a house is worth $200,000 that you want to keep as a rental property, okay? It's worth $200,000. The bank will give you, and this could be your primary, or this could be your investment property, your rental, but it's worth $200,000, says the bank. So they will give you a loan. Let's say they give you 75%. So they're going to give you $150,000. Okay. So your options are to take that as a term loan, like I first said, or what you guys are probably used to doing, where you pay it down over time, but you can't access it. Your other option is to go buy this property with a line of credit. So now let's go get a $150,000 line of credit. Now there's a couple huge benefits here. As you pay that down, well, first off, it's interest only, right? That line of credit, you don't even have to pay principal. So if you run into hard times or you lose a tenant or something happens or cash is tight, you don't have to pay your principal, right? And there's always the dilemma of 30-year versus 15-year, all right? You raise your hand if you're a 30-year guy. Raise your hand if you're a 15-year. I agree, yeah. And it used to be more 50-50, and I've always been 100% 30 because I want flexibility. I don't want to put all that money toward my principal because once I do, it's kind of locked up, right? It's hard to access. But when we go do this line of credit, Now it's all accessible. And now I can go, so perk one is I'm only paying interest only. That keeps your payment low. That means higher cash flow. You guys tracking with me? Because you're not paying any principal. So your monthly payment now, because a lot of you guys, when we evaluate a rental property, we're like, what is the cash flow? But a big part of that is based on your mortgage payment, which has principal. Okay? But if we go buy it with a interest only HELOC, all we're paying is interest. Okay? But now here's the other awesome part of this. When you guys start to scale up, one of the most fatal flaws of real estate investors is liquidity, right? How hard is it as a real estate investor to hold on to your cash when you're a real estate investor and you're looking at deals all the day? Do you want to sit on a bunch of cash and just have it sitting over here just in case? What do you want to do? You want to make it work, right? And I've struggled with this so much over the years. So now one of my mitigators is, rather than having to sit on all this cash because you have to be ready for unforeseen things. Like Steve said today, you got to plan for the worst. Like on the plane, you got to plan for what could happen. This is some strategic planning is liquidity. But now check this kind of silver bullet. You see where I'm going? If you now let's say that you just flipped a house and got a big cash event. Let's say that you just got a bonus at work, all these different, let's say you just had some cash come in. Now, rather than letting that cash just sit, you can take that cash now and go pay off that line of credit. So what I do is that $150,000, if I've got 150 cash and over here, I move it over there and pay down. So now I'm paying 0%, no interest on that house, right? But guess what? I'm still flexible because I could still go borrow against that. Does that make sense? And now so it's one way that I work with liquidity. Now guys, it's more complicated than that. You got to also understand the terms of your line of credit to where they wouldn't just pull out the rug from under you and say, oh wait, nope, we're not, your line of credit is you can no longer pull on it. But from my conversations with banks, they're not going to do that to you. If the only, call it a drawback of these hot lines of credits is they're renewed every 1 to 2 years typically. They're not like 30-year fixed where you do all your paperwork once and you get it and you don't have to mess with it. Typically, your bank's going to want to evaluate them each year. They're going to want you to send financials. So sometimes I was initially nervous. I'm like, well, crap, what if I've got this all, I got it fully, what if I moved all my cash for reserves and I put it into that and then it's time to renew and they say, we're not renewing. Typically, they won't do that to you. They'll just do what they call as a term out. I'm getting way in the weeds here. But what I mean by term out is, because I'm just walking you through the hypotheticals. Because what if all of a sudden now I don't have access to my liquidity? So what they will do, because your financial situation could change, and they're going to look at all your P&Ls and everything, or maybe your credit drops because you're in the middle of a bunch of flips. Typically, they'll just, if you have a HELOC and they don't want to reapprove you, they'll convert it to a term loan. So then you go right back to what you're used to, meaning term loan, meaning they're going to put it 30-year fixed or 20-year fixed or whatever. Did everybody track with me on that? So that's kind of the contingency. Yes, yeah.
Should they switch it to a term loan instead? They decide APR on the spot?
Yeah, you're subject to, but that is another good point. So with HELOCs, they're almost always adjustable. I've been able to fix a HELOC for maybe a year or two, but HELOCs are going to adjust. Okay, so you're going to be paying market interest rates. So the only time, I'll tell you guys this, the only time I would not do a HELOC, which we might never see again, was, 3 years ago when rates were 2.75%. That was the one time I would say lock in 30 years because we're never going to see this again, right? But in general, rates are going to go up and down. Okay, and if you just think about, the other thing is there's a bunch of different ways to look at it, but if you actually model it out, here's the other kicker. Is when you go do a term loan, a 30-year fixed, has anybody ever looked at the amortization schedule and seen how much interest you pay on the front end versus the back end? Almost all your money is going toward paying interest, right? And yes, exactly, until you start to get that thing to mature. So that's why if you run the math on it, even if, I haven't actually modeled it, but I would argue if we ran the math, even when rates were like 3%, if you looked at how much interest you were going to pay over those first 5 years versus if you would have just put that as adjustable rate and just paid what interest was due, I think you would probably still come ahead on the HELOC. Let's break it down again. So let's go with this house that's worth $200K That's appraised value, okay? And I'll show you guys how we actually implement this. And then the second thing I'm going to show you is how you do this on your primary residence. So 200K is appraised for. So most of you guys, if that house, and the cool thing is you can just go buy a rental property like this. You don't have to like go refinance to get the line of credit. You can literally you can't go ask Wells Fargo or Chase or one of those big banks, but you can go talk to your local credit union, your local bank. I don't even know, Jada, we'll have to ask. I don't know if a DSCR lender would ever do they ever do just straight lines of credit on properties? Have you ever seen it? A HELOC, like a first position or a second? First. Yeah, so to be clear, this would be a first position. So a lot of you guys, if you buy that rental property and you got to put 25% down, you're going to get a 150K loan, all right? Because they're going to go up to 75%, okay? So you could go get the term loan. What I'm saying is you go talk to your bank, and most people don't know to ask this, but say, I don't want the term loan. And I keep saying term loan. The bank refers this, their language is a term loan, meaning it has a fixed term, 20 years, 30 years, 15, okay? So you say, I don't want a term loan. I want a line of credit, an LOC. I want a line of credit. So it's backed by the asset, right? And now this is flexible, all right? And this is how you could start to build out your bankroll. You guys see what we're doing here? Is like, once you start to get properties free and clear, or find good deals, or go make money on a fix and flip, or go make your bonus, then you could start, what I would do is start paying this thing down. Right? Because when you pay it all the way down, you're paying no interest. And now because I'm assuming this is a rental property, okay? So let's say this rental property is bringing in $1,500 a month. We'll give you like Wyoming numbers. That would never work in Texas. But let's say you're getting $1,500 a month. So let's say with your loan, your cash flow on this, if you're fully using the line of credit, it's like your cash, let's say your PITI and everything, I could go buy that property and then I could get a 150K line of credit on it because the bank will go to 75%, okay? So if I just went and paid, so scenario one is I just go pay cash for it, and then I ask the bank to give me a line of credit for 150K, all right? And then I don't have to use it, but it's available. And this is like now dry powder ready for me to go and invest or lend or do stuff. And we're gonna talk through like how this works for you guys in just a second, okay? But the other option is I go buy a house, I bring $50,000 to closing, because that's gonna be the difference between this and the loan. And then I tell them, give me a 150K line of credit. So if I only bring 50K to buy this property, then I'm gonna have a full loan amount of 150K. So that's what I showed you here, right? My payment based on that 150K loan is probably like $1,200. So I'm making $300 in cash flow, all right? But what I'm saying is as you keep investing and doing more deals, making the bonuses, flipping a property, then when that cash comes in, instead of having it sit in my checking account, I'm gonna go pay this thing down, all right? But I can keep going up and down with it. Do you guys see what I'm saying here? I'm not probably giving you the best example, but the point I'm trying to make is this is a good way to stay liquid so you can do deals. Because then when I pay this thing off, let's say that I have some cash events and I have cash coming in and I don't want to leave it in my checking account, but I don't want to deploy it. I just go pay this thing off. So now when I'm not deploying the money, now let's say that a big part of my payment, let's say 900 of that was basically my PI, which is principal and interest. Well, I guess it'd be just interest only. So let's just say that was my interest. 900 of that was interest. Now I just added $900 more of cash flow, right? So during that time, now I'm making $1,200 a month on this, right? But the deal still made sense even if I'm using my line of credit, but I can go up and down. It's just a way of saving interest. It's almost a little bit of infinite banking, kind of in a way, all right? So I'm showing this to you guys for a different way to buy rental properties if you have a little bit more cash, okay? And I'm just thinking, when you go talk to a bank, if you're wanting to hold rental properties, I just encourage you guys to look at a line of credit, right? So recently, myself personally, I'm like, on this next loan, this next rental property, just because I have a little bit more cash, because I need to have more cash in my business, rather than me going and get a term loan, give me a line of credit. That way I could pay it down, keep my payment lower, and save a little bit of money on interest, but stay liquid, okay? So now the second part of this is your guys' who has a house right now that they think has some equity to where they could actually pull some cash out of it. So what I mean is, and typically, so in Texas, you guys can go up to 90%, right? On your primary? Is that the rule? I think Texas primary? 80? Some states you can go up to 90. Who's got 90%? You guys did, right? In Phoenix? So I'll say this, on your primary, you can go 80 to 90% of basically AR, we'll call it ARV, whatever your house appraises for, okay? So this is on your primary. So this is gonna be one of the first hacks that one of you guys have to do, one of your action steps out of this next 90 days, is if you have equity in your house, so let's use a scenario. If your house, well, yeah, let's say your house is worth 500K, that's the ARV or the appraised value. I shouldn't call it, it's not ARV, it's just called the appraised value, okay? Yeah, your house, right now, if they came out and appraised it right now, yes, is, yeah, you're right, it's definitely not actually ARV. So it's appraised. But if it's worth 500, okay, you can go get, and let's say that you owe, actually, just anyone want to give you, let's give a real example. Who's got a house that has some equity and wants to share with me? All right, go ahead, Chris. What is your house, what would it appraise for? Your prime? Let's just leave 500 then. That's close enough. Let's just keep rolling. 500, what? But what do you, yeah, that's where you go next. What do you owe, ballpark?
No, sorry, 167.
There we go, 167, okay? And this house is in Texas, so we're saying our max is 80%. So somebody give me 80% of 500.
400.
There we go. That was fast. Good job. So 400K would be basically the loan amount at 80%, okay? So now we know for the cash he can get out. So the one thing Chris needs to do when he gets out of here is go get he can actually, because it's his primary, he can get a second. Everything up here was first position, right? This was your rental property. We're getting first position debt. Now here, because it's his primary, it's a lot easier to go get a second position loan. So because I'm guessing, what's your rate on this 167? Pretty good or just ballpark? 3.8? Oh yeah. So Chris doesn't want to touch this, right? He does not want to, Chris, I can tell you one thing Chris does not want to go do is go do a refinance term out and borrow at 6 or 7%. So what Chris does is he goes and gets a HELOC, all right? So now Chris can get the difference. What's the difference here? 400 and 167, 233. All right, check this out. Now, Chris can go get because Chris also has good credit, I know. He's gonna be able to go get a 233 line of credit, all right? Now he's got 233,000 of dry powder ready to go buy his next rental property, whether to go lend it out, whether to go flip something, whether to go invest in a fund. He's ready to roll, okay? And here's the beauty. To me, every single person should do this. The argument might be, but what if I don't have a deal? What if we're not ready? Casey, I'm taking out more debt. I'm scared of debt. I've been listening to Dave Ramsey. Every day on the drive home, Dave says debt is bad. This is not bad because you don't have to use it. You don't pay interest on this unless you use it, right? So now he's got 233,000 of like dry powder ready to go do deals. And he doesn't get any interest charged until he moves forward. Now, you want to go buy a good investment. When you go pull that thing down, I would not go take it to Vegas and put it on, play some blackjack or put it on the craps tables, right? That would be gambling. I would not advise of that, right? So 233, yeah, I'm guessing you're going to borrow. It's going to be variable interest rate. So I would guess, what do you guys think a line of credit rate is right now? Yeah, let's call it 7.5. You're right. It's very, very dependent. Okay, let's call it 7.5. So if he can go put this into a deal that gets more than 7.5% return, then he's winning, right? But yeah, he should not go put it into, you could argue that some people might, years ago, people would say, go invest in Austin. And even if he makes 2.5% in Austin, but he's counting on appreciation, he could still win that way, right? But you just got to make sure when you go invest that. So yeah, definitely do not go do this and not invest. Some people invest without cash flow. I wouldn't recommend it, but you can also play the appreciation game. The other cool thing about is if this is a rental property or if it's your primary, but you got better incentives if it's your primary, but he doesn't get taxed on this. This is because he could also go sell this high, because I know too, he's got some assets he could sell and clear it. But if he goes and does this, it's not taxed because taking out new debt is not taxed. Here's the thing I always talk about. Your first option to go borrow money is the bank or the credit union. Try to get them to do this. Sometimes they're not going to do that one. They might not also do your rental property, right? Because you're not living in this. There's just banks, a lot of banks are different. So if your bank doesn't do it, my next step is go to a private money lender, right? And then this is how I secure so many of my private money lenders is they'll take me up to this point. Or if it's a sub-2 deal with equity, you could get a PML to do that. And if you can, like James said yesterday, wrap up the package with a bow on it, show them how there's equity, show them how there's, I erased it, show them how there's cash flow. Some of my private money lenders they actually prefer lending in second position versus first, which that might blow your mind. You guys know why? Because A, they know that this asset is performing, it's renting, right? If I take this back, I'm walking into cash flow. If I take back your flip that's halfway done, like James talked yesterday, and you've spent all the rehab budget or have a bunch left, I got to step into a project and like, I don't want that, right? But my lenders are like, first off, I know you're not going to walk away from this, Casey, because you wouldn't walk away from that cash flow and that equity, right? So some people actually like that better because it's more stabilized. You know what I mean? You're in second position, they would have to pay off the first position loan, but there's still equity.
So you're not
Good.
sure if they would let you do a line of credit?
It's so state specific, it's so bank specific, but I would go ask. So back to my point yesterday, go talk to your local credit union and we could talk offline. What state is it in?
Texas.
In Texas? It's in here in Houston. And it's a rental property with, how much, what's it worth and how much, what's the property worth? Right now, your rental property, you think?
865.
865. All right. How much do you owe on it?
0.
Free and clear? Yes. Perfect. Thank you. Thank you for the case study. All right. Yes. Oh, this is why, guys. This is why we're opening these doors, okay? Because I knew there would be people like this. This is great, right? Your job, you could go to any bank because there's no bank. There's no underlying loan. You can go, don't go to Wells Fargo. Don't go to big banks, right? Don't go to Rocket Mortgage. Go down to a local bank or credit union, and they're going to take you up to 75% probably all day. As long as, it depends on the cash flow, right? It's still got a cash flow based on the debt. And at 865, you might not get 75% of that, but I can almost guarantee you can get half of that. You could probably get 400,000 at.
Are they going to look at what the cash flow is in the rental?
Yes. Yeah, what would that house rent for? Or what is it renting for? It's a rental, right?
Yeah, like 4,050.
4,500.
Yeah, it's not renting to. No, 4050.
Oh, okay. 4,050.
Yeah.
4050. We would we'd have to look at you. We could pencil it out, like what your payment would be on. Yeah, because what you're going to have to do is the math on. Okay, so it comes actually, we're really getting deep here, but it'll come down to like your DSCR. You would just go talk to a DSCR lender. She's probably got it, Jada. Yeah, give them what's a rule of thumb? 2% of that. So 2% of 865K, what's that? This is actually a good exercise. Let's do it. 217 a month? Or sorry. 17,000. Give me it per month. 1,500. Holy shit. First off, this is why I invest in Wyoming and not Texas. Okay, 2,500 a month, taxes and insurance. And again, this is why. But it's okay, because I know some of you guys own properties. Okay, so anyway, so she's basically got, this is the income that's coming in. So if we had it just break even, let's say you could get a lender to do like a 1.0 DS or DSCR. DSCR means like the debt service coverage ratio, right? So does it count? If it's 1.0, it means it's breaking even. But typically, Jada, what are you seeing on a DSCR ratio?
It's got to be at least 1.25.
1.25? 1.0? Look at that. They can get 1.0, okay? So this is going to allow us, so guys, track with me, okay? So that means we've got 1,500, 1,500, all right? So now we know that's how much we could put toward basically interest. So we just got to back into like what the current interest would be. Yeah, just give me the monthly, what's the max loan amount you could get her? 475, okay. So again, that's a complicated calculation. I would definitely talk to Jada when you guys, if you're trying to figure out this math. But basically, we're saying that your loan amount you could get is 475K of cash. Like in her scenario, it's going to be cash, which also works. You could also go to another bank and just do the line of credit to where then that's going to keep your payment down. Okay? But anyway, see that? So she's got 475K to go deploy in other deals. And keep talking. Does that surprise you that you had that much liquid dry powder ready to go?
No, yeah, I'm surprised. So Who would give me 475?
Any. I mean, Jada will, or your local bank, and I would look at both, and I would compare both.
Just so I understand this. So you're saying because it's a rental, she should do DSCR. For me, because it's primary, should be HELOC.
If it's just, okay. Yeah, really quick question. So Chris asked, if it's your primary, it's a little bit different because he's already got a loan. So he should go get a HELOC, a second position HELOC. HELOC is home equity line of credit. Let's just call it lines of credit. So you should get a line of credit at second position from, you can actually go to most banks, right? And again, I'll just tell you guys my opinion. I like DSCRs if I'm like not planning to pull money in and out. But if I'm trying to do this, if I own a house free and clear, I'm going to a small bank or credit union and saying, hey, will you get, what is the maximum? They'll just tell you. They'll run their numbers and they'll say, I can give you a loan for $400K. They might say $500K. But what I would ask them is say, I don't want a term loan. I want you to give me a line of credit based off this value. And they'll run the numbers based on the cash flow. Go ahead, Keith.
What's the advantage of a small bank versus a Rocket mortgage in a case like that?
Yeah, they're just, and just all the hoops. So you're going to jump through so many freaking hoops to try to go get money from Rocket Mortgage on a rental property. You could, you still could go to, you could actually, well, there's a finite amount. You can only get up to 10, but honestly, in my experience, once you do more than 4 of these Fannie Mae, Freddie Mac secondary market loans, the underwriting becomes such a pain in the butt that you would rather just go. And honestly, not many of them are going to, they're not going to do a line of credit. They're going to always do the 30-year fixed.
The smaller banks. What's the 13 number? Hold the debt.
Exactly. Yeah, so the small bank is going to hold this. Remember James talked about balance sheet loans versus selling them, selling the paper? When you go get a secondary market mortgage, right, you go to Wells Fargo, Rocket, they're going to go sell that loan, right? You want to go to the bank who's going to put this on their balance sheet. And again, guys, now you're building a relationship with them, right? I would take your business to them or take somebody to like Jada where you're going to get to know them. They're going to get to know you as a borrower, and that's going to let you continue to grow. Guys, that's how I grew my portfolio, was I got to know those guys. And I started doing deals with them, and I started paying them back, just like a PML, right? I was using their money and paying them back and communicating well and making their life easy, putting a bow on it.
I don't know if you want to share what I did.
Yes. Yeah, give the quick case study there.
My primary, I have a condo. I had a medical event last year that I needed to refi.
So tell them numbers. What was your house worth when you refinanced it last time? So she's living, how much is it worth? Or what did it appraise for?
300,000.
So it appraised for $300K. Before you refinanced, what was the loan amount?
The loan.
Roughly. $231. Okay. And how high? They went up to 90% on her primary. So what's 90% of 300? 270, right?
It was 269.7.
So that was the new loan. So what Carolyn did is she took the difference here. How much cash did you get out when go ahead.
My condo appraised for 300,000. So when I refinanced it, the original mortgage went up to 231, and that pissed me off. So I then had it reappraised with a new bank to recast it into the first position HELOC. And since it's still appraised for 300, I took out 270, paid off that 231, and a high interest, like a consolidated loan
Yes.
of the other half of the medical debt. So I'm all in, like I've maxed out my HELOC. I've been paying it down now.
Yes.
I've put what you did, I put all my W-2 pay, all of my savings, everything, it's like a checking account. Put it all in, pay down the principal, and then that becomes liquid that I can use to then invest in real estate, get more cash flow. So that
Yes.
I can pay it off faster.
Yeah, so Carolyn has become her own bank. So let me just break this down though. So she, again, instead of going to the bank and saying like everyone else does and saying, I want to go get a term loan or a refinance and getting a new loan at maybe 270 or whatever, but locking in her principal and having to me, she was locking in any extra cash. She gets a $270K. This is a HELOC, right?
Yep, it's a HELOC. My rate was almost exactly the same as my refi, so I'm at 8.25.
8.2%, right? But again, don't get hung up on the rates and terms because it's so different deal to deal. But just I want you to focus on, she got a HELOC for 270. right? So she paid off her other loan. So the difference she was able to, it sounds like she paid off some other bills, right? And this might help some of you guys, right? So I just did this with my acquisition manager. She's like, Casey, I eventually want to buy a rental property, but I've had I have a lot of like personal stuff come up that she was actually fighting for her kids and having to pay for a lawyer and attorney to keep her kids. And she had equity in her house. And she's like, Casey, and my credit's tanking because I got high interest credit cards. I'm like, Judith, what is your house worth? And it was kind of like this. She's like, oh, it's worth like 300. And I was like, what do you owe on it, Judith? And it was a similar story. She's like, I only owe 231. I'm like, Judith, go to the bank and get a loan for 270 because the difference here is what? 270, but what are we, 39? 39,000. I'm like, Judith, go take out the 39K, pay back your attorney, pay down your credit cards, right? And then maybe you'll have a little bit of extra money for either for savings or to invest, right? And she did that. And I should pull up my phone right now when she's like, she did it, took her about a month. And she's like, Casey, oh my God, my credit score is back because I paid down there. I'm not losing all this money every month in my credit card interest, and I'm keeping that money. And now I've got a little bit of money to potentially invest, right? And Carolyn's doing the same thing. And now Carolyn is chipping that away. Even though she basically maxed it out, is what she said, is she's now chipping it away each month as she makes more money, gets bonuses, and pays it down, right? But it's not locked in. Now, Carolyn, what do you have available on it right now? So I'm going to keep moving to the next one. But the reason I went into this, like, who has a property right now they think they could do this on? Raise your hand. That's got some equity. That could do it. I know you can. Yep, you guys too. George? Okay, cool. You guys as well. So this is this is like option one. The first thing I always tell, the easiest thing you could do is this strategy to go free up some capital. You guys see the power of it? And then that's, again, whatever strategy you want to do, we're going to get into your guys' 90-day next, whatever that is, you could do whatever you want. Okay, self-directed. So this is another good one. Who currently has a self-directed IRA? Lots of you guys. Cool. Another great opportunity. So I'll give you this. My kind of quick in a nutshell cheat code to this, because as Lisa said, and we're talking with Carolyn, this is a great way to go be a good PML. Okay, so what you want to be careful about, though, this is not a great strategy to go build your own rental portfolio because, yeah, there's a lot of rules, especially on taking out debt. But really cool hack is, I know a lot of you guys are in sub 2, you can buy a property sub 2 because in a self-directed because you don't guarantee the loan. Because the restriction is you can't go get secured in non-recourse. You could do non-recourse loans, but you can't do recourse loans. Recourse means that you're personally guaranteeing it. Okay? So if you went and bought a sub 2 property, the cool hack is you're not guaranteeing that. The former seller is. So you can actually buy one of those properties in a self-directed, all right? But to keep it really simple, this is a great way to invest, all right? Especially or in like Revive Club or in a fund. I highly recommend it for being PML or PMP or basically lending on someone else's deal. It's much cleaner. A little tip too, some of you guys probably know this, because there's like a maximum you guys could put into your 401ks, right? And your self-directed and your Roth. Okay, and you can, because a lot of people are like, that's a great strategy, but I can only grow it. What's the minimum now or max? 8,000? 8,000 a year. You can only put 8,000 a year. So you're like, well, how the heck am I going to have enough money to even do any damage at 8,000 a year? So it's all going to be different based on the retirement account type. But here's the hack, is if you change jobs. So we were just talking to a couple of people at lunch. Oh, was it Herbert? Yeah, we're talking about his wife. He's like, my wife's got some funds. My first question was, has she changed jobs? Because you could do what's called a rollover. And when you do a rollover, you could go take all the money that you've been investing, getting through your company in your retirement account. You guys, like, for example, who switched jobs? Who's recently switched jobs in the last couple of years and has a bunch of money in their 401k with them? Yeah. Did you do that? Did you do a rollover?
Yeah.
Cool part is that's one way to like juice this thing up. I don't know if juice is the right word, but if you want to really get this thing increased, is if you change jobs. But the other option is what I told Herbert today is if you haven't changed jobs, but you've been working, like if I was Will right now, he's been at Cameron/Schlumberger for years. He's been there so long, he should ask if he's got basically how it's vested. So what Will needs to do is Will needs to go call, what is it? Do they do it through Fidelity or who's it through? Fidelity, just like same with Shell. So I would call Fidelity and I would say, hey, how much am I allowed to self-direct out of your account? I don't know if you made this call yet, but it's...
I have two separate ones. I have self-direct and then I have
the 401k. But you can ask, okay, can I self-direct part of that 401k? And it just depends. Every company's a little different. But back to this, on the HELOC situation, all that interest is going to the bank, right? And you're getting access to capital. Now you're borrowing against your own retirement money, and their interest, instead of going to the bank, Michael, he's saying it's going to his retirement, which is really cool. So I'm gonna keep moving to the fourth one. But again, so I'm gonna have you raise your hand one more time, and after you raise your hand, you're gonna write it down. Who has like a 401k or an account like that they could look into? I would be doing that, all right? So I would write that down. That's one of your actions, is to go figure out, go look into it. Like when I was at Shell, I just literally logged into my Fidelity thing and it had a little option, told me how much they would lend me. And I would go see what that number is, and then I would at least know what it is, because now you got some liquid capital ready to go. Go ahead, Keith.
But you cannot if you no longer work there, right?
No, I could. Yeah, actually, I still have some in my Fidelity from Shell. What's that?
If you don't work there anymore, you can't take a loan out of it, correct?
No, I don't think it matters. Because it's my 401k with Shell Fidelity. So mine is a good example. I don't work for Shell anymore. I still have some money in my Fidelity account, my 401k. I can go, but I could actually go self-direct all that now too if I wanted. Well, we got to be careful when you lend to yourself, but yeah, but it can be doable. Okay, got that one? So hopefully I've given you a couple tools, all right? Whether you got money in the stock market, Bitcoin, whatever that is, see if you can borrow off that, so you can borrow off your house. And I'm not telling everybody to go take a bunch of debt. I'm just trying to figure out where is your dry powder, because I know a lot of you guys want to take action on your 90-day plan and go get those big visions, right? And this isn't for everybody. If you're I don't think anybody's the Dave Ramsey type in here, but if you are, you don't have to do what I'm saying, right? But if you have bigger goals and you want to do more and you can take smart risks, like guys, the infinite, some of you guys were in the room during Golden Ticket when, what was his name again? The infinite, Curtis Ray. He's like, do this, but he's like, make sound investments, right? Once you start to create these lines of credit, if you make sound investments, that's how you win, right? So I just want to show you guys how to access the capital. So now, 0% interest credit cards. You ready to go to the final one? And then we'll workshop, okay? So 0% interest credit cards. I would kind of put these into two buckets, right? I would say your stuff that's in your business name and stuff that's on your personal, okay? We'll start with stuff on your personal, right? I have my Home Depot card. I have my Chase cards. I have a bunch of, I was going to bring them up and show you, but a bunch of different credit cards that I'm using in my business. There's a lot of personal ones. The personal ones, they show up on my credit. So when for example, we talked about this at lunch, when I'm using my Home Depot card, when I make a big purchase, you get like 12 months interest only. Sometimes it's like 24 months, 0% interest to use that Home Depot card, right? And I'm like, heck yeah, that's 0%. That's a free loan, right? I got to pay it back, but I'm not paying any interest. But it's in my personal name, so that impacts my credit score, right? So I got to be careful. My credit score, if we went and pulled it today, probably just because I got a lot of Home Depot cards, I'm probably closer to 700. I've even seen it drop down to like 680, 650 if I've got a bunch of Home Depot cards that are 0%. But when I pay them all down and I get my usage, it's called your utilization rate, which means how much, if my Home Depot card is about 70,000 is my limit, depending on how much I borrow. Let's say that I borrow 35,000 is my balance and it's worth 70K. My utilization is 50%. You want to typically stay under like 30% is the safe level to like have the best credit score. So mine fluctuates from like 680, 650, all the way up to like, if I'm got them all under 30, I'm like 780. And it fluctuates a ton, okay? But the personal cards, you just gotta, it's a little bit of a balancing game you have to play with to keep your score high. Go to Chase and say, hey Chase, I wanna open the next credit card. I wanna do your business, instead of your business Inc., I wanna do your business cash. So they open a new credit card and I got a new 20K limit, okay, at 0% for 12 months. And this is all you have to do. This will blow your mind. All you do is get on the phone with Chase. You call them and you say, hey, I got this new credit card. This other one is paid off and has an 80K limit. I want you to take the credit line of 80K, add it to this one, okay? And now my new limit is 100K. Okay, easy math, right? But guess what? This 100K, because it's on this new card, is 0% for 12 months.
Yeah.
So, what's that? Oh yeah, sorry, I did it on 4 cards. You're right. I went boom, 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 added them all to the new one, which is really cool. And we just did it on a phone call. And I'm like, why are you letting me do this? Does this guy know what the rules are? See, is this guy new? So you see this guy? So I've been doing this for year after year after year. Right now, my last year, I have a $160,000 limit 0% interest credit card that I can put tons of my flip stuff on. Right? And I do that every year. So for Revive Club, what we're doing, that's why the cool thing about Revive Club is what I found out was when I was doing all these, I had partners, right? And my partner went and got 20K and then I got 20K. And then my wife got 20K. Anybody who was listed on the LLC agreement could go borrow based on their credit. So that's what's cool about Revive Club, which I'll talk about in just a second, is we went and anybody who's on that LLC can go apply for a credit card. So a big part of that is I'm going to help you guys all go through and apply. And then we're going to go use that as part of our fix and flips to fund some of our deals.
What's the highest credit limit that you have on one of your credit cards?
Well, the one card, because I kept rolling it, was 160,000. Yeah, but that takes a couple years. Although some of you guys, I've seen, I was talking to somebody, actually she's in Revive Club. I won't say her name because she might not let me, I should have her permission. But her husband just took out one with Chase that got 120,000 on his first card. But he's like you. So because Chris has other businesses and he has revenue and has business credit, you could probably get over 100K on your first card. One little cheat code is if you could pay a company like Fun and Grow, and there's other ones out there, where you could pay them to go apply for these, because there's also a whole game of like, what Fun and Grow does is I paid them $3,500, and their thing is like, we can get you approved for 120 to 250,000. They told me based on my credit score and my businesses I had going on. But they know, because what they do is they went and applied for 3 credit cards immediately, like all at the same time. And then they spent the next 3 months getting those scrubbed off my credit report. And they've got this little insider stuff they do. It's actually not that complicated, but you could pay somebody to do it, or you could figure it out yourself and watch YouTube probably. But they go do it for you. And then 3 months they reapply for more. So they got me like initially like 60K. 3 months later, they got me like another 60K. And they do that over like 18 or 12 months. And that helps you get a bunch of 0%. And then to me, I would do that and get started. I mean, if you're not part of Revive Club and you just want to do that, you could go pay somebody to show you how to do it. And then once you get the credit lines, like, so I did it the first time, and then now I've got the credit established, and now I just play the game every year. Edgar's saying is, now each year I'll go pay it all off, and then I know how to just go call the Chase guy and say, hey, please apply for a new credit card. And then I just move all my credit over and just keep moving. The faster I can go take on 0% debt versus normal bank debt, because here's the point I wanted to make, guys. So this HELOC, as I told you, back to the Dave Ramsey, poking fun at him, like very low risk to go do it, to go get the money accessible, because you're not paying any money. But you will pay like a 1% origination fee to get this available, which I still think is totally worth it. But these 0% interest credit cards, you can go do that for no charge. And when you open up the new one, like there are some cards that have annual fees, but I know Chase's, there's no annual fee, right? Like the Chase Inc. or Cash or whatever it is. There's no fee. So there's literally, you could just go open it up. Like there is zero down. I mean, I better be careful. I see very little downside to going, if you don't use it. I mean, once you use it, you're making your own decision. But to go open a credit card, there is no cost. And now you have opportunity, all right? I would say there's an incredible opportunity. You can decide what risk you want to do as far as investing that, all right? But very little downside, right? Yes, we didn't even talk about points. Guess who gets all these points? Right? Guess on our Revive Club, who's going to get all those points? Me. No, I'm just kidding. No, the people who are borrowing this, they get to use all the points.
Is there a monthly payment on that money?
There is, yeah. You need to make the minimum payment. Minimum monthly. Yeah, so like on Revive Club, we're going to treat it just like bank debt. We will still make the minimum monthly payment. It's not a distribution. It's just your monthly payment. Just like it would you would pay to a bank, right? But yeah, it'll definitely be paid to pay the minimum. Yeah, it's really low. It's like 1% divided by 12. So a couple quick things is, if you want to convert this to cash though, there's a cash advance fee, right? It's around 4%, right? Which you guys particularly seeing? So yeah, you're going to pay a little bit. That's why I love using it for like materials, subcontractors, all the stuff like your utilities. So it's a great way to do it. Okay, but again, I want to be very clear with this strategy. It is risky if you go do this and you don't have a plan. You don't have your flight plan, like Steve said, of what happens after 12 months. And you're like, oh crap, I lended this out and my PML didn't pay me back. Well, I mean, yeah, you're still on the hook for it, right? They don't care about your PML, all right? They don't care that your flip ran long. You got to be ready to pay this back in 12 months, okay? All right, so those are the 4 ones. Any questions before I move on about those 4?
I assume HELOCs, if everyone had about 4 days.
Good question. I like that question. Chris, my favorite. What do you think? You think it's HELOC? My favorite is 0%, because it's like this is got 0 cost if you do it the right way, right? This has got a very small cost. And guess what? This requires assets. This is just based on your credit. Yeah.
You're doing it by house, right? Or you
No, but I'm saying go pay. Here's the perfect blend is what we're doing. Good segue. I'm going to talk about Revive Club. I'm going to explain how it ties into like Revive Summit and Revive, these other cool Revive things we're going to show you, because we got all these Revive things. I'm going to break it down in just a second. But Revive Club, okay? Raise your hand if you're in a Revive Club. All right. We almost got like 70% of the room, okay? So Revive Club, it's not too late, first off. So if you guys are interested, I would come find me, okay? There are still spots in Revive Club. But what Revive Club is, what we're doing is it's a fractional offering with me. And we're going to be targeting a lot of fix and flips and buy and holds. You're basically going to be doing deals with me, right? As my investing partner, right? Now you don't have to be accredited. So my fund, I have Bighorn Capital Fund, and then I have Revive Club, okay? Bighorn Capital Fund is for accredited investors only, okay? And the minimum is $50,000. So I've been doing that for several years. It's a great opportunity for me to raise capital. But I wanted to find a way, and honestly, Revive Club was started because I knew I was going to be in a room like this where not everybody is accredited yet. I know I guarantee you guys will be accredited if you're not yet soon, okay? But I wanted to still have a way to work with you guys and do deals with you, but you weren't accredited. So that's why I'm so thankful for Fractional, because Fractional created this cool offering where you guys are partners, right? You're not, on my Bighorn Capital Fund, you are a limited partner, right? You are considered passive in terms of like the SEC rules, okay? On Fractional, you are an active owner in the company. You are listed on the Revive Club operating agreement. Every one of you guys is going to be listed, whether it's your name or your self-directed IRA or your LLC. You're going to be listed on that as an active member. We will vote. You will be voting on all the deals, but I'm sharing it. I want to answer your question because I saw this cool opportunity of 0%, but I'm also like, but I don't want to pay the 4%. Right? And what we're talking about, the 4% is like converting the 0% interest credit card to cash. So the cool, what I found is the coolest blend is we're raising $1 million through Revive Club of cash. So we'll have $1 million of cash to go deploy, and we're paying 10% on that. But then my goal is to go we'll see how much we get approved for. It's a number I don't know, and we won't know until everybody does it. But after we close and sign our operating agreement, then we can start the next step, which will be applying for 0% interest credit cards for whoever wants to. It's not mandatory, okay? Anybody who wants to participate can go because your name is on that LLC operating agreement. You can go apply for a 0% interest credit card, okay? And we'll see. I have no idea how much we're going to get approved for, but we're going to go do that. And then now what we're going to do is when we go fix and flip, now we've got the cash to go pay for the down payment, or maybe it's a sub 2. I mean, the cool thing is we can just go do sub 2s. And then we could just go fund the rehab with a 0% interest credit card. That'd be one way to do what you're saying. But with Revive Club, we'll be doing some of that. We'll also be buying some buy and holds to like put the money to work right away so we can start making that 10%. But what we'll do on a lot of our fix and flips is my LLC will go borrow the money because it has like relationships with banks. And I don't want to make 50 different people go sign on the mortgage. It's hard enough. It's a pain in the butt enough for me to have to sign on them. So I'm not going to make you guys do that. But we'll go borrow on the property, or we'll take over property subject to. And if there's like the entry costs, that cash will come from the $1 million raised. All right. But then when possible, we're going to use the 0% interest credit cards that everybody's approved for to pay for the rehab. So it's actually going to let us go do more deals and have more than $1 million available to go do more deals. So it's a 2-year deal. We're going to be doing as many deals as we can over 2 years. My goal is to do at least 20. Hopefully we'll do more. So anyway, so Revive Club is still an option, but I want to be very clear the distinction, right? So Revive Club is just like Bighorn Capital. Bighorn Capital, Revive Club, they're over here. These are investments where you guys can partner with me, okay? Revive Club is active. Bighorn Capital is passive and accredited only, okay? Now, what you guys are here for today, though, is Revive Summit. All right, so I don't want to confuse you guys. Revive Summit. And I did the Revive Club. I had a really cool offering with that. And that's why a lot of you guys are here today was as one of the perks for signing up for Revive Club is I knew I really wanted to pour into you guys and have you in the right room and learn and help teach you. So we had a lot of cool perks with free VIP tickets and free general admission tickets for the people who were in Revive Club, got invited to Revive Summit.